Welcome back, you all. Greg Silverman here from CIOs and Bow Ties. We're going to have another CIOs and Bow Ties series pretty soon. I've been warming up our economist, Dr. Crook. I'm going to bring him back on the show, so I'm not sure what we're going to speak about, but it'll be fun, so join us for that. Another session of Come Learn with Me. You take my breath away, markets underlying deterioration. Yeah, I'm glad this one actually came up because I've noticed that. So let's investigate by Liz Ann Saunders. Stock market could use some mouthwash. Breadth in the S&P 500 remains fresher than either the NASDAQ or Russell 2000, but it's also been deteriorating. Generally, market breadth indicators highlight the percentage of stocks in the index trading above moving averages, or the number of stocks rising relative to the number that are falling, often incorporating volume statistics as well. I do like that statistic. An analogy often used to explain why breadth matters comes from the battlefield. Whether the generals are on the front line, but the soldiers are lagging behind, the force is less powerful than when the soldiers are on the front line alongside the generals. What? Okay, got it. Let's start with a very broad look at breadth. As shown in the chart below, although the S&P 500 traded at an all-time high as recently as last week, the cumulative advanced decline line for the broader NYSE universe peaked on June 11th this year. I know exactly what they're talking about. I do. The divergence between the two looks similar to early September last year. So that was when? Early September last year. The point at which was mostly the big five stocks within the S&P 500, the generals, that had powered the S&P 500 to its September 2nd, 2020 high. Yeah, great explanation, I think. So same things happening here, I guess, is what they say. Divergence. Spotlight on major averages. As shown in the first chart below, the percentage, the percentage of S&P 500 stocks trading above their 50-day moving averages peaked in April. Troughed in June, improved until recently, but has come under pressure again. Got it. April. Go back to April. Right. The same can't be said for the NASDAQ and Russell 2000, which both peaked in early February, since which time they've generally been descending relative to their 200-day moving average. All three indexes have been generally trending lower since April, as shown in the second chart below. So this is what's happened to percentage of stocks above 50-day moving average. All right, so more and more stocks are falling below their 50-day average, which belies the average, weakness in the average. In 200 days, same effect. In the case of the NASDAQ, new lows have exceeded new highs recently, even though the index hit an all-time high as recently as August 5th this year. This is strikingly different than the massive breadth thrusts of the NASDAQ from last November through this past February. Sector, breadth, volatility. At the sector level, as shown below, energy's breadth stinks the most. While given the market's recent bias towards classic defensive areas, utilities have the freshest breadth, followed by financials. Percent above. I see. Okay, so they're comparing them each to each other. Energy, wow, very low. Utilities, of course. Interesting. REITs defensive nature, huh? Lower interest rates. The bias recently towards traditional defensives likely reflects growing concerns about COVID's Delta variant's impact on economic growth, but also the peak in the growth rate for both the economy and earnings, as well as fading fiscal and monetary stimulus. All year, we have been highlighting fairly rampant sector-based volatility, shown in our sector quill chart below. I love quill charts, which rank each S&P 500 sector from best to worst on a monthly basis. Volatility, which we expect will persist, is one reason why we have only one outperform rating on the S&P 500's 11 sectors, healthcare. To read more on our sector ratings, click here. So these are always nice. See which one's on top. So basically the leaders are changing from month to month. Yeah. Volatility within sectors. Calm before storm. Notwithstanding the aforementioned risks associated with deteriorating breadth, the S&P 500 has gone 200 days without at least a 5% drawdown, as shown in the first chart below. This stretch is not yet near prior peaks. Wow. The three most significant having occurred in 1965, 94, 96. But historically high nonetheless. The maximum drawdown this year so far has been minus 4.2%. Since the S&P 500's inception in 1928, there have been 3 calendar years with a maximum drawdown even less than that. 1995, minus 2.5, wow. 2017, minus 2.8, 64, minus 3.5. It begs the question whether the market is overdue for a pullback. So the table below the chart may help answer this question by looking at the S&P 500's modern history. So this is 5% drawdowns within a year. Consecutive days without 5% drawdowns. S&P 500 performance following final day of at least 200 consecutive days or more without minus 5% drawdown. Okay, this is interesting. So these are the last drawdowns. The average. The subsequent return. What final days of at least 200 consecutive days or more without a 5%. Doesn't say how. Okay, performance is 1 month, 2 months, 3 months. Got it. 1 year after that event. Next. Wow, pretty low, huh? Performance. As shown above, although the sample size is not significant, prior 200 plus day stretches without at least a 5% drawdown ended with mixed to fairly weak subsequent performance short term. Over the subsequent 1 to 2 months, returns were positive less than 30% of the time, with both average and median returns below the all-period average and median. Longer term, the results were mixed, but mostly weaker than the all-period average median returns. As shown in the final column, over the subsequent 1 year period, the maximum drawdown ranges from minus 11 to minus 26. Got it. That's good. Expect drawdowns. Increasingly, I've been asked by clients during our many virtual events about whether the US stock market is in a bubble akin to 99, 2000. My answer has been a bit more nuanced than a simple yes or no. The tech bubble burst in spectacular fashion in March 2000, driven by absurd valuations and massive speculative excess. Presently, at least for the S&P 500, valuations are less stretched courtesy of the epic rebound in earnings. The surge in E has resulted in significant move down in the PE. But there has been significant speculative excess in less traditional pockets of the market. Since late 2017, I've been calling these pockets microbubbles. These pockets have experienced drawdowns at some point this year that have been much more severe than the traditional index drawdowns. Here are some examples of market segments or securities with greater than bear market level maximum drawdowns at some point this year. Okay. So that's very good article. So there's been a lot of weakness under the surface, and I bet you this weakness has been, without even having looked at that, the weakness has been in the most favored stocks. Okay, what do you know? Bitcoin, down 53. GS, non-profitable technology stocks. GSO, down 38. SPACs, down 37. Renaissance IPOs, 29, down 20. GS, most shorted stocks. So that means you short the most shorted stocks or buy the most shorted stocks? I guess you short. No, you buy most shorted stocks. Meme stocks, GameStop down 88, AMC, BlackBerry, Clover. Well, that's the maximum year-to-date drawdown. Doesn't mean that's where they are right now. Okay. So yes, there is weakness under the surface in some. As summer winds down, we soon head into September, historically the worst month. Let's see when this article is from. August 23rd. Okay, that was recent. As summer winds down, we soon headed into September, historically the worst month for stocks in terms of average performance. Aside from seasonality, there are several risks with which the market is confronting, including deteriorating breadth, fading monetary and fiscal stimulus, peak earnings, economic growth rates, and of course the Delta variant. We've really got it. Individually or collectively, though, they should not be taken as a get-out message. For stock pickers out there, we would recommend a focus on quality via factor screening, both within growth and value indexes. I agree. Not a recommendation. Important disciplines to heed in the current environment are diversification, both within and among asset classes, and periodic rebalancing. With regard to rebalancing, it's one of the most beneficial disciplines in that it forces us to do what we know we're supposed to do. Add low, trim high. Yeah. I've always been a big proponent of rebalancing. Notice I adjusted that from the classic buy low, sell high adage, which can infer an all or nothing strategy. Frankly, investors should never think of investing as either get in or get out. This is gambling on moments in time, while investing should always be a disciplined process over time. Very good. Couldn't have said that better myself. So fantastic. Good article. Nice technical. I bet this person could be a CMT. No? Oh, Charles Schwab. Okay. Well, great. Thanks, guys, for joining me. Good article as to why we could be facing a bear market, I guess, under the surface, under the averages. This is Greg Silverman. Have a great day. Out.